We appreciate all of the guests who have appeared on our show and sincerely thank them for providing you, our audience, with useful information. However, the advice our guests provide is theirs, and we encourage you to seek out a professional if you have specific questions about any topic we cover on the Crushing Debt Podcast. On this week's episode of the Crushing Debt Podcast, Sidestep the Market Crash.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law, and I have a guest for you this week. But before we get to my guest, I do want to bring up our sponsor, Sam Cohen at Attorneys First Insurance. Those of you that have been following me for a while know that he writes errors and omissions insurance, malpractice insurance, professional liability insurance, whatever you want to call it, for attorneys and title companies all over the country. Now, right now, he's got a particular focus on Florida, where he's based, and Texas, and can write some pretty good policies for attorneys and title companies in those areas. So a great way to support me, a great way to support the show, is to support our sponsor, who will keep giving us money, hopefully, to keep getting these episodes out to you. And the best way to support him is to introduce him to an attorney or title company whose malpractice insurance is about to come up for renewal. And so you can contact him, Sam at attorneysfirst.com or www.attorneysfirst.com, or you can email me and I can connect you or the potential attorney or title company over to Sam at Attorneys First Insurance. But I have a repeat guest, and so my guest was on episode 196 of the show. So I will let you go back and listen to that show where I do a complete bio. But one of the reasons I wanted to have him back on is because he wrote a book. He wrote a book called The 401k Revival, and so all about how to sidestep the next market crash. And so I read the book, fantastic book. I highly recommend it. You can get a copy of it at the 401krevival.com. And again, I'll put that link in the notes. You can get a copy of your book. And so what I wanted to do was have my guest and the author of the book and my friend Mike Watkins back on the show to talk about the 401k Revival. Welcome, Mike.
Hey, thanks for having me, Sean. Appreciate it.
So I guess the first question right off the bat, why did you write the book?
You know, I'm in the financial service business. I meet with people that are trying to prepare for their retirement. And over the last 10 years, I've seen a reoccurring theme, and that is their retirement accounts are woefully inadequate to take care of the retirement dreams that they want. And so when we map everything out on paper, a lot of times, many folks just don't have the resources to live the life in retirement that they want. And in almost every case, Sean, I can trace this back to their losses inside their 401ks in the 2000 and 2008 market crashes. And then, of course, just recently we had 2020. So when I revealed to these folks, Sean, that many of them could have double or triple the amount of money that they have in their 401ks today, simply if they could sidestep a market crash, that would be the results. And so that's really why I wrote the book. And also, Sean, I think a lot of folks are trained to think they just can't get past the fact that they could actually have the ability to sidestep a market crash and not lose a boatload of money. And many people just think that, you know, as the market goes, that's the way my money's going to go, and there's simply nothing I can do about it. And that is just not the truth. It's not. So I wrote the book to try to help educate people and meet them where they are and help them understand that there are certain things that they can do to sidestep a market crash. Now, it doesn't mean that you're not going to lose money in a market crash. Okay, right. I just want to be clear for compliance purposes, because when a market crashes, everybody's going to lose money. But just think of it. What if you just lost a portion of what everyone else is losing?
Right.
And a significant portion is saved. It's kept intact, and that allows the power of compounding to work. When you lose less, you get to keep more.
Right. And so one of the questions in there that I had, and I know one of the things I want to talk about a little bit later, is the liability of the business owner to provide the financial advice. But my question though is, do you think that some people don't have enough in their 401k because they think, well, my employer provided it, so I'm going to deposit into it every month, and I'm going to do my employer match every month, and I'll let whatever advisor my employer handles, I'll let them deal with it. Here's my money, go take it and grow it, and let me know when I can retire. Do you think that's the issue? Or, do not enough people take, and obviously the employee doesn't necessarily have to take an active day-to-day role in what the 401k invests in, but maybe they're giving too much control to the financial advisor that the business hires to manage all of the employee 401ks. Do you think that's the issue?
Yeah, partly. Yeah. And so what we're talking about, Sean, is we're talking about a saving instrument that was designed over 40 years ago. Okay. And it's a buy and hold strategy. And the whole idea of it is to diversify, right? We've all heard that word, diversification. And so they have baskets of mutual funds. And, theoretically, yeah, it's going to help you somewhat. But when a market crashes, it crashes. And I don't care, the best designed mutual funds are going right down the tubes with it. It might be the difference between 46 and 50% losses, but there just is no, protection there. And so when we start using these prepackaged mutual funds, when there's no oversight or leadership there, I think that's really the biggest danger, Sean, because I work with people who are engineers and they're brilliant people, very, they're like statisticians almost. And, even those folks just continue to make the same mistakes. And it's really an area that I think that needs leadership, and it needs what is called a Section 338 investment manager, which I am not, but I have one that I use. And when you have somebody, a watchful eye at the wheel, guiding the ship, they can steer away from safety really quickly. And so I think to answer your question, it's really that, to be fair to the business owners, look, they're doing what they do. They make the best widget around, and they have a great business going. They don't know anything about, the investment world, but yet they are tasked with that liability to make sure that everyone that works for them that's inside that participates in their plan has all the investment advice that they need, and it's just not happening.
Yeah, I mean, I've told this story before on the podcast a few different times and in a few different contexts, but I remember when I was a young attorney, had just moved to Clearwater, had been practicing for 3 years, working at a pretty substantial law firm, a small law firm, but had some substance behind it. And the employer offered me a 401k, and so I met with the financial advisor. And I'm a young guy, at the time, 3 years out of law school, 3 years as an attorney. And I sit down with this financial advisor. And keep in mind, my undergrad degree is in accounting, so I'm no slouch when it comes to finances. But I recognize as well that, and I followed the stock market and the Wall Street Journal. And so I understand it. But I met with this financial advisor who's also kind of a young guy. And I said, well, I don't know. I'm an attorney, so put me in a courtroom, let me draft motions, let me draft contracts. I'm comfortable picking what I want to invest in, whether it's a mutual fund or a stock or a this or a that. I really don't know what I'm doing. Can you help me? And he said, well, here's some information about my company. Go ahead and read it, and let's talk again. And okay, and I grabbed the document and I look at it, and I'm like, there's lots of pretty colors on here, and lots of cool pie charts and graphs, but I don't know what any of this stuff means. And so I left the meeting, went home, tried to sort of slog through it. I couldn't make heads or tails of what the heck was going on, and met with him a couple of months later. And, again, it was, well, did you review the information? And I said, well, I reviewed the information, but I didn't really understand it. It had charts and colors and graphs and all kinds of cool stuff, but I didn't really understand it. And he said, well, why don't you, and he gave me like an updated version or something. And I was like, look, I'm going to deposit, X amount of money from my paycheck every month. The law firm that I'm working for is going to match up to, I think it was like 3%. Whatever, I don't care. Invest it. I want it in the market somewhere, invest it. And I sort of walked away. It wasn't until about 3 years later, when I had left that firm and started my own firm, I went to a different financial advisor and basically said the same thing. I know what I'm doing, sort of. I have some background in finance and accounting, but I really don't understand the stock market or mutual funds and that kind of stuff. He took the time to explain it to me, not to the point that he was teaching me how to invest, but to the point that we could have a conversation about it. And
Right.
I rolled everything over to him, and he's still managing it to this day. But
Right.
but that's why I brought up my initial question was, I got frustrated, and I wonder if there are more financial advisors out there like the first guy, and less like you and the second guy, where let's take a collaborative approach. Let's talk about it. Let me at least explain it to you, where I don't necessarily need you to instruct me on what to invest in, but at least when we talk about it, we're on the same page, right?
Right.
That was my story of investing in for. It's kind of traumatic, but at least I made it through it. So, what is the you talk a little bit in the book. What is the business owner's liability to provide investment advice? I mean, if I start a 401k for my law firm and my employees, is it really my responsibility to provide the investment advice, or could I hire somebody like you to manage it for me, for us?
Yeah, that's a great question. So, yes, if you start a 401k, Sean, you do have a legal and fiduciary obligation to your plan participants. And that means providing them with adequate investment advice. The way that this usually goes with businesses, and I'm not knocking businesses, again, they do what they do, and managing investments is not something that's really in their wheelhouse. And so it's traditionally been left up to the plan participant, the employee, to go in and pick a basket of mutual funds and so forth and so on. And of course, the business owners will have, an investment guy, maybe from, Schwab or Fidelity, A-Lite, whatever plan provider they have. And they talk about, the things that they have inside of their 401k plan. So the question, I guess, is that enough to shield you
right
from legal liability?
Yeah, that's what I was going to ask. Is me having that plan advisor between me and the employees, is that enough to discharge that fiduciary obligation?
And that's what all the attorneys will have fun with in their day in court, right? To determine that, whether or not that actually happened. Employees get confused with all this, and I think a lot of the business owners do too, quite frankly. But like I mentioned before, nowadays, just over the last 3 or 4 years, Sean, there have been giant leaps forward inside the 401k industry to bring about change, to bring about, asset protection, for lack of better words. And so we've all heard about robo-advisors, right?
Right.
Well, technology is so sophisticated now, it's giving a lot of investment managers a heads up when the market crashes. And so, for example, last March, during the COVID crash, the technology that I used was able to warn in advance their subscribers 2 weeks ahead of the crash. The first warning said, move 30% of your money to whatever allocations there were in the core lineup. The second warning came out about a week before the crash, said move another 30%. And then a few days before and during the crash, the last notification went out and said move your money to cash and so forth and so on. So a regular 401k plan does not have that capability. It's set it, forget it. You buy and hold, right?
Right.
So with using technology and or piggyback technology with active management, then you have that watchful eye looking at your 401k, and they can take swift and immediate action. So I guess the question is, how much? Well, that remains to be seen. We don't know when the next market crash is coming, how quick, how severe, or how long a recovery might take. But without any type of defense, you're really just a sitting duck bobbing around in a sea of extreme volatility.
Yeah, that was something that was really interesting to me right off the bat in the book, was that the bigger the drop, the longer it'll take to regrow to pre-drop levels, so to speak.
Right.
Was kind of interesting to me. The other thing that really caught my attention that I didn't know anything about was at the end of the book, anti-IRMA, income-related monthly adjusted amount, and is that something that contributes to how and why people don't effectively have as much in their 401k as they think they do? That seemed to be the way that I understood it.
Well, no. The IRMA legislation that is directly tied to Medicare, the government-run health insurance that all of us are probably going to be relying on in their retirement. When we're 70, 80, 90 years plus, whatever. And so the whole system is broken. And I'm not going to get on this rant about, government debt, which is at an astonishing $30 trillion. It used to be an urban myth that Social Security was going to go away. I mean, the likelihood of all this stuff is starting to get more real every day. But the IRMA, the income-related monthly adjusted amount, has to do strictly with the income that you have saved for retirement. So what's going to happen is it's really going to penalize the people who have done a good job and have saved a pretty, substantial amount of money for their retirement. And they're sectioned off into different categories. So for a traditional 401k is one of them. Municipal bonds, pensions, Social Security income, all of these, the incomes, the IRS is going to calculate, and they're going to determine how much you're going to have to pay for the Medicare insurance. So we've heard over the last few years, paying your fair share, right? Well, this is how people get to pay their fair share. They don't have a choice in it. If you've saved, more money and you go over certain thresholds, you're just going to pay a lot more for your health insurance, and you don't have a choice in it. However, there is a workaround. And guess what, Sean? You might be surprised to hear the IRS is going to come to your rescue. That sounds pretty funny, doesn't it?
They're going to tax you, and then they're going to come to your rescue.
Well, right. But the IRS, there's certain things, there's certain ways to position your assets so that it doesn't show up on their radar. Okay. So that's why it's really important to work with an advisor that knows about, some of these hidden things inside the 401k that are going to come down the tracks at you. But the sad thing about IRMA, Sean, is people really aren't going to see how damaging this is until they're about 80 years old. It's about between 78 and 80 years old. And that's when the cost of your Medicare could potentially outweigh your Social Security benefit, leaving you with little or nothing in your Social Security benefit, just
Wow.
so that you can have health care. So, it's pretty scary.
Well, and I guess that was sort of the point I was very poorly making was that if the cost of Medicare for you goes up because of Irma, then that's effectively less money you have to spend within your retirement, effectively.
Yes, correct.
Okay.
Absolutely. Yeah. Sorry.
No, and that's okay. Like I said, I probably just asked it really in a bad way. So, one other question I had. So if I have an employer and I'm contributing to my 401k, I'm the employee. Let me take myself out as the business owner for right now. And maybe it doesn't matter. But if I'm the employee and I'm contributing to my 401k through my employer, and let's say that the investment advisor that the employer uses is someone at Schwab, can I have my own advisor for my 401k, or do I have to use that Schwab advisor, for example?
That's a great question. And the answer is no. You get to choose who you work with. Typically, Schwab would be the plan provider, okay? And the employer, like yourself, Sean, would be the plan sponsor. So Schwab would, set up the platform for you. They would probably bring in their advisors and show you certain baskets of mutual funds, give your employees risk questionnaires so they can, determine their risk tolerance, whether they're, conservative, moderate, or aggressive, and then build the baskets of mutual funds around that. So, but the employee can go a step further. They don't have to do that at all. And there's two ways to go about this. Like I said, there's technology that's available that you can purchase on a monthly basis. It's $9 a month. And what it does is the 338 investment money manager, that their firm goes in and they analyze what you have, let's say, for example, in that Schwab account. And they analyze it and they send you back a report and say, okay, you need to have 15% in American funds, you need 25% in Vanguard, on and on and on. And they help you properly rebalance what you have, okay? But then more importantly, you get quarterly updates. So it's like you have an investment manager looking over your shoulder and monitoring your accounts. And so it keeps you, in balance and they fluctuate back and forth. But guess what happens in the event of a stock market crash? You get notifications on what to do. So you're not alone. Right. You have a 338 investment manager looking over your shoulder, telling you exactly what to do so that you can escape a large portion of the crash.
Okay, got it. And I know you didn't talk about this in the book, and we didn't talk about it sort of pre-interview, so I'm sorry to put you on the spot, but I probably within the last 2 or 3 months, came back from a cool little seminar out in Orlando all about blockchain and cryptocurrency. So I am curious, from the financial advisor perspective, what's your opinion of cryptocurrency and how that might sort of impact some of these strategies that we're talking about?
Yeah. Okay. Yeah, I'll weigh in on that. I tell you what, there's some multimillionaires walking around right now because of cryptocurrency. It's strictly speculation, okay? Just like gold, gold could go through the roof. It could be, $2,000 an ounce. We're hearing all these commercials about hedging your portfolio with gold and all of that stuff. I see nothing wrong with taking a little bit of risk if it's suitable risk, okay? And I'm talking, maybe 5 or 10% of your portfolio. If you're willing to roll the dice and swing for the fence with your retirement plan, I think it's pretty unwise. But to answer your question about cryptocurrency, I have no crystal ball. I don't know where it's going to go. China, for example, is cracking down on that.
Yeah.
And so the government likes the U.S. dollar. Our government likes the U.S. dollar.
Sure.
And I think when something like cryptocurrency gets, mixed into the equation there, there's going to be a lot of eyeballs looking at this in the future. And I have no idea, what could happen. But, I guess if you're in it and you're making money, enjoy the ride.
Yeah.
Enjoy the ride. But one thing I would point out, Sean, if you've made, 100, 200, 500, $1 million off of this, I would say it would really be a prudent move to take some of that off the table.
Yeah.
At least 50%. And then that way you're playing with house money, so to speak. And, and if it all goes to hell in a handbasket, then you're like, okay, well, at least I made $100,000 off of it or whatever. And I only invested $5,000. So I guess I did pretty good on that investment, right?
Right. Well, but I guess and again, my uneducated question, what's the difference between, saying, well, cryptocurrency is speculative. Well, isn't the stock market? Aren't mutual funds? Isn't gold? I mean, isn't everything to an extent now? And I know part of what you have in the 401k revival are the proprietary systems and whatnot that track to sidestep the market crashes. But
right.
But fundamentally, isn't everything sort of a gamble?
Everything in the stock market is. Absolutely, it is.
Okay.
It is speculative. That's for sure. However, I will say the volatility aspect of it is not there for the stock market like it might be in cryptocurrency. We've seen these wild swings, right? And there's different coins that come out. So, so my advice would just be, take a little bite if you want, nibble, and enjoy it. And I hope you make a lot of money off of that or whatever, penny stocks or whatever else is coming down the pike. Lithium is a big thing that people got into years ago, and they're hoping for a big payday on that.
Right. Okay, well, cool. As we sort of get near towards the end, anything that I didn't ask, anything that you want to say about the book, again, which if you as a listener here for the show are interested in getting your copy of the book, again, it's at the401krevival.com. And again, I'll have the link here in the notes. But if you want to get your copy of the book, it's a fantastic read. It's not long, and it's not complicated either. So that's what I enjoyed about it, is that it sort of broke things down in a way that I could understand it, and it's not a 700-page novel. It's a decent sized little book. So anything that I didn't mention, anything that you wanted to bring up?
Well, I would like to bring this up. So like I said, a lot of folks are they can't get past the thought of, can I really sidestep a market crash? And the answer is yes. And so they really have they have three options. They can use the prepackaged accounts that come with their 401k and just say, okay, I'm taking whatever comes my way. Or two, they could use some technology, small subscription fee, get quarterly rebalancing. They have to do it themselves. It's not going to happen automatically. They have to go into the back office of their 401k and move things around inside of their plan. But then the third thing is, probably about 60% of the plans out there, Sean, have a thing called 2R option. So look in your plan and see if you have the 2R option. And what that means is now, if you have the 2R option, you have the ability to bring in a 338 investment manager to monitor your account. Now, you get to throw all those prepackaged mutual funds away and get what I call real mutual funds that the 338 investment advisor puts together for you. So it's head and shoulders above prepackaged mutual funds. But so in closing, I'd just like to say that there's help out there for you. You just have to look for it and, contact me through the 401krevival.com. We'll set up a phone call. I'd love to give you some sage advice, meet you where you are, and hold you by the hand through all of this, because I don't know what's going to happen in the future, but I do know one thing. If you don't have some type of defensive posture in place when the next stock market crash happens, it's just talk to somebody that experienced the 2008 crash. It's pretty painful.
Yeah, it is. Well, thank you. I really appreciate it. Those who have listened to the podcast for any length of time know that I read a ton of books, and so I really enjoyed reading yours. I would very, very highly encourage it to anyone who has a 401k, wants to get a 401k, wants to put a 401k in place. I mean, regardless, whether you're the employee that's investing or the employer that wants to provide the benefit to your people, definitely pick up the 401k Revival. Definitely reach out to Mike Watkins. And I think for purposes of this week's episode, I think that will do it. Thank you. I appreciate you being a guest on the show again, Mike.
You bet. Thanks a lot, Sean.
So, again, pick up your copy of the 401k Revival. It'll definitely help you to have more money at the end of the month rather than more month at the end of the money. That'll do it for this week's episode, and we look forward to talking to you in next week's episode of the Crushing Debt podcast.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.